If you hold PSLV, your bars are sitting in Ottawa right now. Not in a digital ledger somewhere, not as a claim against a bank's balance sheet. Physical silver bars, each one with a serial number, each one allocated to the trust, sitting inside the Royal Canadian Mint. That detail sounds simple. It is not simple. In the current structure of the silver market, that detail is the entire argument. And this weekend, 3 things happened at the same time that every PSLV holder needs to process before New York opens on Monday morning. Not to panic, the opposite. To understand exactly why the position you are already holding may be one of the most strategically placed in the entire precious metals complex right now, and to know precisely what to watch when trading resumes. Let's start with what PSLV actually is, because most investors receive a poor explanation, and it costs them clarity exactly when clarity matters most. PSLV is not a standard exchange-traded fund. It is a closed-end trust operated by Sprott Asset Management and listed on NYSE Arca. Every share represents fractional ownership of real, allocated, audited silver bars stored at the Royal Canadian Mint in Ottawa. Those bars are not pooled in a general custodial account. They are individually identified. Every bar has its own serial number tied to the trust's inventory records. When you own PSLV, you own a documented, verifiable claim on specific metal in a specific vault. The net asset value of the trust is calculated daily. Total ounces in the vault, multiplied by the global spot price of silver, divided by total shares outstanding. That gives you the NAV per share. The market price of PSLV then trades around that number, sometimes below it, which is called a discount, sometimes above it, which is called a premium. That relationship between market price and NAV is not just an interesting footnote. It is one of the most meaningful signals in the silver market. Here is the mechanism that almost no mainstream financial channel ever explains clearly. PSLV has an at-the-market share issuance structure. When the trust trades at a sustained premium to its NAV, Sprott can issue new shares and use the proceeds to buy additional physical silver for the vault. That means demand from investors does not just push the price of a financial instrument. It creates a direct pipeline pulling real metal out of the global market and locking it inside an allocated vault. Sustained premium equals physical acquisition. That is why large institutions monitor the PSLV premium line. It tells them something real about where physical demand is going. Compare that structure with SLV, the largest paper silver vehicle in the world. The custodian for SLV is JPMorgan Chase Bank in London, according to its own filings. Retail investors cannot redeem SLV shares for physical bars. The holdings are not individually segregated the way PSLV's allocated inventory is. In normal market conditions, the price movements between the two products look nearly identical, and most investors never notice the difference. But when the silver market enters periods of genuine stress, structural differences stop being academic. They become the only thing that matters. The environment entering next week is not normal. 3 separate catalysts arrive this weekend. Each one is meaningful on its own. Together, the way they intersect creates a specific kind of pressure on the silver market that PSLV holders need to understand from the inside out. The first catalyst involves Iran and the Strait of Hormuz. The regional conflict has moved into a stage where energy markets are actively pricing disruption risk. Roughly 20% of global oil supply moves through that corridor every single day. Oil closed the week in the mid-80s. The level that matters is $90 per barrel. That is not an arbitrary number. $90 represents the transition point where geopolitical tension stops being a speculative concern and starts producing structural inflation pressure across the entire commodity complex. Follow the chain of logic from Hormuz directly to your PSLV shares. Energy supply disruption raises production costs across every industry that depends on fuel and electricity. Manufacturing, mining, electronics, transportation, all of them face rising input costs. When businesses anticipate higher costs, they pass those costs forward into prices. Investors respond to rising prices by searching for assets that historically protect purchasing power. Precious metals immediately enter that conversation. And within the precious metals complex, silver occupies a particular position. When the gold-silver ratio moves into the 60 range while inflation expectations are rising, silver has historically begun outperforming gold. The reason is partly monetary and partly industrial. Silver is a hedge against inflation and a critical input for the industries that build the infrastructure of the modern economy. That dual nature amplifies its response when energy costs threaten to run higher. And every move in the spot price of silver feeds directly into the NAV formula. It is not a correlation, it is arithmetic. The second catalyst arrived Friday morning. The Bureau of Labor Statistics released non-farm payroll data, and the number came in significantly below expectations. That matters for a specific reason. The labor market had been the Federal Reserve's primary justification for holding interest rates steady. Strong employment gave policymakers the cover to delay any shift toward lower rates. A weak labor print removes that cover. When markets begin pricing the possibility of rate cuts, the US dollar typically weakens. A weaker dollar has a direct and immediate effect on globally traded commodities, and silver is priced internationally in US dollars. When the dollar loses strength, buyers operating in other currencies gain purchasing power. Chinese manufacturers sourcing silver for electronics production, Indian jewelry producers, European investors, sovereign funds across the Middle East. All of them suddenly find silver cheaper in their own currencies, without the spot price in dollars moving at all. Demand increases across multiple buyer categories simultaneously. That dynamic alone can produce significant price moves. But silver carries an additional layer that other commodities do not. Because it functions as both an industrial input and a monetary hedge, a weakening dollar activates two separate demand channels at the same time. Industrial demand grows through the currency effect. Investment demand grows through inflation concerns. When those two channels open together and physical supply is constrained, the resulting pressure can be substantial. Which brings you directly to the third catalyst. Physical silver is leaving exchange vaults at a pace that has significantly exceeded historical averages this year. Millions of ounces have moved through the COMEX delivery system. Total inventory across exchange vaults remains large on paper. But the critical distinction is between registered metal and eligible metal. Registered metal is immediately available to settle futures contracts. Eligible metal is stored in exchange vaults, but not necessarily available for delivery. The ratio of registered silver to total open interest in futures contracts is the coverage ratio analysts watch most closely. When that ratio becomes extremely thin, it means the market has created far more paper claims on silver than it has immediately deliverable physical metal to honor. Now add the context of a recent margin adjustment that reduced the capital required to hold silver futures positions. Lower margins make it cheaper for large traders to initiate positions or to stand for delivery. If a significant buyer decides to demand physical bars rather than accepting cash settlement, registered inventory tightens quickly. When metal leaves the exchange system, some moves into private storage, some goes directly to industrial users, and some flows into physically backed vehicles capable of holding allocated bullion. PSLV is one of the most visible destinations for that metal. This is where the structural distinction between PSLV and paper silver becomes directly relevant to your position. When market participants begin prioritizing physical ownership over paper exposure, demand for allocated metal rises. When institutional capital starts rotating towards structures that guarantee real bar ownership rather than derivative claims, the PSLV premium to NAV often moves towards zero and can flip positive. That shift is not just a technical curiosity on a data dashboard. It is a signal that the market is beginning to price physical scarcity differently from paper exposure. Two realities deserve honest acknowledgement. before discussing how to use this analysis. First, tax treatment for PSLV depends on your account structure and regulatory elections. Because the trust is classified as a passive foreign investment company under U.S. tax law, different reporting rules apply depending on whether you hold the position in a taxable account or a tax-sheltered account, and whether a qualified electing fund election has been made. Investors who have not reviewed those details should do so before significant gains force decisions under time pressure. Second, there is a theoretical concern sometimes raised about government intervention in foreign precious metal storage. Any government retains legal authority over assets within its jurisdiction. However, the Royal Canadian Mint has operated for more than a century and has no history of seizing privately held bullion from trusts structured the way PSLV is structured. The theoretical risk exists. In practical terms, it remains extremely low compared to the counterparty risks embedded in leveraged paper markets. What you actually do with this analysis is straightforward. The weekend is a preparation window, not a decision window. Start by checking the current premium or discount of PSLV relative to its NAV and recording that number. If the discount narrows meaningfully over the next several sessions, it signals increasing institutional demand for physical exposure. Watch crude oil prices as the geopolitical situation develops through the week. A sustained move above $90 confirms that energy markets are pricing real disruption, not speculation. Monitor the daily futures reports tracking open interest in upcoming silver delivery months. A sudden expansion in positions can signal large buyers preparing to stand for physical delivery rather than rolling contracts. The most important discipline is distinguishing between noise and signal. Headlines will arrive every hour. Markets will move up and down. But the structure of your position does not change unless the underlying indicators change. Your bars remain in Ottawa. The vault accounting remains transparent. The NAV formula remains exactly what it was. 3 scenarios could unfold as trading resumes. Escalation in the Middle East, pushing oil sharply higher and strengthening the inflation narrative. Temporary de-escalation, producing short-term volatility without altering the deeper macro trends. Or continued tightening in physical silver availability as institutional buyers compete for real metal in delivery markets. Each scenario produces different short-term price action, but all 3 operate against the same structural foundation: the balance between physical supply and investor demand for allocated metal. If the signals stay neutral, patience is the correct response. If one signal strengthens, attention is warranted. If multiple signals strengthen simultaneously, the market may be entering a phase where physical ownership carries a premium that paper exposure simply cannot replicate. The silver market does not reward emotional reaction. It rewards preparation. Your bars are sitting exactly where they were before this weekend started. The difference now is that you understand the forces moving around them.